and welcome to this hot money special on what next for the Indian markets. To discuss more, joining us on the show, we have Manish Sonthalia, Director and Chief Investment Officer at MK Investment Managers, and Andrew Holland, CEO at Avendus Capital Public Markets Alternate Strategies. Overall, if you see from a market perspective, interesting themes that are playing out, gentlemen. Firstly, we've been talking about the US elections. Post that, you have the Maharashtra elections that are, impacting markets as well. Manish, first, let me come to you. We've seen earnings in this quarter that have not really played out well. Markets have been underperforming global peers. You have Maharashtra elections, which has given a slight bit of a boost. And you have US elections that is behind us now. From here on, how would you advise investors to first play the markets?
So, with the earnings of quarter two behind us, the outlook on FY25 EPS for Nifty 50, according to me, stands at 1050. And from our viewpoint, FY26 will not see more than a 10 to 12% earnings growth. And similar is the number, at least at this point in time, we can understand that FY27 is also going to be around 10 to 12%. Even assuming 12% earnings growth for both the years, so 1050 as the base case for FY25 gives you 1175 for FY26 and 1315 on EPS for Nifty in FY27. Average of FY26 and 27 gives you a 1250. My sense is for a 10 to 12% earnings growth on the Nifty 50, markets are unlikely to give a 20p multiple plus, which they are doing currently. A long period average on Nifty 50 is closer to 18 times. And with now, there being a TINA factor in that, the US market is likely to be the strongest market and emerging markets are vulnerable, I think it's more prudent to assign highest margin of safety to where Indian markets could, find support. So from that point of view, I think around 22,500 gives you the highest margin of safety. The Maharashtra elections is definitely a sentiment booster, but one thing also to be kept in mind is the two elections where you have seen the parties win is where you have the benefits of direct benefit transfer. That is to say, the household sector is a whole lot of stress out there, and whoever is giving some boost on comfort on income side or the demand side of things are winning. So hopefully things are going to get better with all these things, the Maharashtra elections being over, government spending requirement, plus some income booster in the hands of people should come as, come in handy. So that's how I would believe that, that is how we are actually placed. You could see the markets fall even from these levels. It could be a temporary pullback.
Right, Manish, I'm going to come back to you, with further down drill on this one. But Andrew, let me come to you as well. Overall, we've spoken about the tepid earnings, sticky inflation. There have been withdrawals by foreign investors as well. How are you looking at them, and how would you advise investors to play? Because it seems that the Maharashtra-led rally that we are seeing in today, and it is start of the opinion that it probably is a short-lived one.
See, I'm not sure. I mean, I think there's a few things here. I think the market last week, Tuesday, was starting to show some recovery, and then of course we had the on Thursday morning we had the Adani news, which took markets down, and by the end of the day we're in that hugely oversold territory. So anyway, you would have expected a 2 to 3% bounce in markets from those levels, if you want to call it a relief rally, whatever. So the elections itself just added extra to what we saw on Friday, with the kind of thinking now that with this out of the way, with some other elections not far in the future, that the government will get back to spending money. And start ordering in terms of projects and so forth. So capital goods would be one of those beneficiaries. On the large cap side, valuations are looking a little bit more reasonable compared to small and mid caps. But to be honest, I think we're in a range of 23 to 25,000 on the Nifty. because there's no real catalyst. There's no earnings catalyst. Even if the government starts spending, it's probably more of a 25, 26 story than it is, for the balance of this year. So I expect probably more downgrades to earnings going forward. So with that in mind, I think, short term, you might get that kind of Santa Claus rally. FII is usually kind of very kind of absent anyway towards the back end of December. But then come January, everything changes with President-elect Trump coming in, and we don't know what those tariffs, what's in store for emerging markets. But for sure, the game in town remains the US, and that's where the focus is going to be. So don't expect foreign investor flows to abate in terms of selling very soon. But it's I don't see at this point flows rushing towards emerging markets until some of those policies and clarity around them is starting to be forthcoming.
Andrew, that's an interesting aspect that you're talking about as well with regards to the government spending, the multiplier effect that it could have. And what happens with regards to when Donald Trump's administration policies become clearer. But that becomes from a macro perspective, whether the FIs look at India or an emerging market or not. What would you advise a retail investor who's really invested in the markets, wanting to see how can I make money do? What would you advise that retail investor at this current juncture?
See, if I was a retail investor, in fact, I am an investor, right? So, sitting on some cash can be a strategy also. I'm not talking about intraday kind of trading or short-term trading, but between now and January the 20th, hopefully we'll get some clarity about how things are going to move. So even if I miss 1 to 2% of, maybe more of the market moving up, as long as I can see there's a greater trend going forward on the upside, then I can go back in again. But the risks with the valuations where they are, if anything is untoward, then obviously our markets will see the kind of falls that we've seen recently. So I think that, as I said, there's no catalyst for fundamentally to be buying aggressively our market. But I just see a little bit more downside in terms of possible, around the kind of tariffs that could be introduced. And don't forget, let's just say, there's a narrative going around that tariffs may not be, the 60% on China might not be enough in terms of it will be lower than that. If that was the case, then that would be good for China, right? And therefore, you could see a stimulus package from China as well. So flows would definitely go towards China. So we might get some flows as a passive part of those inflows into emerging markets, but it's not going to be, the kind of flows that we've seen in the past when valuations were more reasonable.
Right. In fact, taking cues from what Andrew is saying, Manish, what would you do? Because Andrew says that, yes, it's not a good strategy. It is a good strategy probably to sit on some bit of cash as well. How are you looking at it? Because I don't think so that the FI selling is going to be abated anytime soon. Yes, probably the quantum will reduce, but they getting into the buying spree is still far away. How are you looking at it from a retail perspective?
Yeah, so, I agree to the fact that, you couldn't for sure believe that, this is the end of the FI selling, and just because you had a pullback on Friday and today, because it was so surprising that even on Friday, the FI selling was there in the cash market. So, it's a matter of principle whether you want to hold cash or not hold cash. As a matter of principle, I don't believe in sitting on cash, because if clients have given you money, it's basically for you to get invested. But I think there'll be sectoral churn. I think the top sectors where one could find comfort, and because there is a propensity for INR to depreciate, there would be bigger margin of safety in buying into export denominated sector. And because in the US, there would be a propensity to have corporate tax cuts and invest in technology name. Technology is one area where I could find very high comfort to invest even in current market levels. Same goes for a pharmaceutical. Even that space is quite conducive. I think the banks as a whole, a large weightage in the index, has seen decent earnings growth. Valuations are extremely conducive. And there we have a decent a margin of safety. So in spite of the markets not looking too great at the Nifty level, I think sectorally these would be some of the sectors where one could find comfort. The high beta sector, which is relying a whole lot on government spends and private capex, look very vulnerable even now. Even though there is a belief that H2 would be much better in terms of government spends, because government does understand where the problems are and they will lift up the spending, which has been anemic in the first half. All of that is within the realm of possibilities yet to be seen. But today the markets seem to be believing that that's all come, and which may not be true. So valuation comfort is not there in the investment related theme, so to speak, and definitely not there in the private capex side of things. Private capex is just not happening. The private capex is totally absent. So these would be vulnerable sectors and areas clearly to be avoided.
Right. So these are sectors to avoid from a private capex perspective, and that's an interesting take. In fact, when you talk about the government spend as well, from the budgeted in terms of FY25, hardly I think 40% is what the government has spent. The remainder, whether the government will be able to catch up or not, is what we need to wait and see. Andrew, again, for you, which are the sectors that you would like to actually bet on, apart from leaving some cash on the sidelines, if you have to look at the markets now?
Just to clarify about the cash on the sidelines, what I'm trying to say there is that if you want to wait for some of these events to play out, if you're more conservative, then it's a strategy you could use, because when markets fall, as we've seen with mid caps and small caps, everything gets tarred with the same brush, even the good ones. So that's the time just to kind of let the dust settle a bit. But in terms of sectors, I think if the government spending is going to pick up, then obviously capital goods sector looks good. I think the banking sector, because valuations are quite reasonable, then that remains an area. But I don't think the RBI is going to cut rates. I think it's going to be well into 2025 now, which would be means that NIMs will remain under pressure for the banking sector, and regulations seem to be getting tighter. So I think the banks versus NBFCs, I'd probably have banks at this point. Then, of course, I'd look at the themes that will continue to play out. One is the electronic manufacturing sector, which obviously will be a beneficiary of what Trump policies will be going forward, and hospitality, travel experiences. I was keen to hear what the Indian hotels management was saying. It's and if you speak to anybody, hotels are just booked between now and February for the the end of March actually for the wedding season. So I think that sector continues to do well, and premiumization in terms of the drink sector, both non-alcoholic and alcoholic. So those are the themes I like, and I think I'll continue to invest in. But in the short term, volatility of the markets will be there, particularly going into January.
Right, the volatility with regards to markets is expected to continue. In fact, on specific data, let's look at a couple of stocks, on the back of the MSCI rejig as well. Now, on the back of the rejig, you are expecting some bit of inflows to come in. If you can just quickly have those graphics on the screens, and that will tell you what you're looking at. There you go, stocks like Voltas, BSC, Kalyan Jewelers, Oberoi Realty, Alchem Laboratories. These are few areas where, you are expected some funds to come in. Manish, your view on the back of the MSCI rejig and the flows coming in, do you think this is something that is already priced in?
Yeah, I mean, generally it happens that whenever the announcement comes and the day on which it becomes effective, there's already a pricing that, that is already effective that you see on the screen. But some of the consumer discretionary names look quite vulnerable after the effect of MSCI pricing does happen, because see, consumption is really stressed today. The household leverage, which really built up during the COVID times, thanks to government increase in fiscal deficit. You saw a whole lot of travel, tourism, restaurants, QSRs, all of that, is now really, it's hitting you at the margin because government is reducing fiscal deficit. So, there has to be a helping hand in terms of demand revival. So some of the consumer names do look very, very vulnerable, and more so on the consumer discretionary side of things. And some of the valuations do look pretty exorbitant, even after the correction that you have seen. So, it's a wait and watch mode. Mid-term to long-term trajectory on some of the consumer discretionary names look perfectly fine. But if you are buying into things which is 3 PEG or more, I don't think there's too much of capital to be made buying at these valuations. Let the earnings revive, because if there's an earnings slowdown on the consumption side of things, and things do happen and come in late, these will have a repercussion on the consumer names, whether it be automobiles, whether it be white goods, or any of that. So I think discretionary consumption looks stressed at the moment.
Right. So discretionary consumption is something which is in doldrums to some extent, absolutely, like Manish was pointing out. Andrew, how are you looking at the consumption space? Because clearly, you have your FMCG majors who've come out and said that urban consumption is something which is dwindling. Rural is picking up, but that's what is impacting the margins and the earnings growth as well of all of these companies. So traditional FMCG companies versus the new age tech consumption companies, where would your bets be?
Oh, definitely new age technology. I mean, the growth is there, the volumes are there. I think for the traditional FMCG companies, they're grappling with two things. One is that volume growth is just not there, and margins, are under pressure. So, and it's a very competitive market. So I just don't see that they can get the growth at the moment. It's a place to hide at best. If global markets were coming under any sort of pressure. But at the moment, I think the new age technology companies are probably where I'd probably kind of say that you're going to see continuous growth. It might be a little bit lower and slower than people would like at certain stages of the growth, kind of momentum. But I think that all of that's fine, and I think we'll continue to see them taking market share. So I think this is the this is a kind of backdrop for this sector. It's going to be tough. It's going to be tough for those companies. But it's not just the FMCG companies. I mean, across all sectors, apart from a few companies here and there, volumes and margins were under pressure, and that's why you had such a dismal earnings season. And I just don't see that getting better in the very short term. So more downgrades are coming for sure. So, if we sum it up and what Manish said at the beginning, if he's looking at 10% earnings growth or 12%, then, you could really say that markets could move up in line with earnings growth. But if those are going to be under pressure, then as well going into next year, then, your return expectations have got to be a lot lower than they have been in the past. So it could be a testing time for the markets. But individual stocks and sectors, yes, you will find some winners. But I think at the moment, we're all going to be grappling with how is it going to look into 2025? And unfortunately, that's a bit cloudy at the moment.
Right. So that's with regards to where consumption goes. Manish, coming to you with regards to Trump's America First policy, how do you think that will impact Indian businesses? Because right now the key is what happens with regards to the potential import tariffs. Will they actually, open up opportunities for India to increase its market share? Or you think there could be some bit of backfire as well? Because all of these companies who were exporters to US have been sitting on huge capacities, which is underutilized yet, right? So there are two sides of the story. How would you look at this space, and what's your view?
So the new regime change in the US will exactly know how things will shape up post January the 20th. Because there's a lot of speculation about what's going to happen or not going to happen vis-a-vis tariffs when it comes to India and China, etc. I think it all depends on the fact that there is going to be protectionism in the US. It's about manufacturing shifting back to the US. That's what is being alluded to. I think there will be tariffs, but what sort of retaliatory tariff India puts will determine how much of competition you would have on the trade deficit, etc. Because if it is a tit for tat, then we have a problem. But otherwise, uh, just believing that whatever the new regime has talked about in terms of doing after the new regime comes into power, there is going to be a protectionism that is going to be there. And of course, U.S. markets, U.S. economy is the strongest. It's going to be a TINA factor as far as the U.S. markets are concerned. It's going to be the strongest market. U.S. dollar is likely to be the strongest currency. All other currencies in emerging markets look quite vulnerable. So all these things will actually play out, and these are writings on the wall. But exact policies on how things are going to shape up will depend on how governments react to the new policies that will be used by the new regime in the US, and that we'll know in January 25.
That will know in Jan 25. Andrew, your view, because clearly, the moment you see higher US corporate tax cuts, there is some bit of enhancement with regards to IT spending, benefit our companies in India. However, a stronger dollar and a possible tariff could undermine Indian exports. So what would you advise if an investor wants to take a bet on this aspect?
Yeah, there's no clear kind of answer to this because we have to wait for those policies to come through. But what I would say is this: is that the positive side of a corporate rate tax in the US is obviously earnings in the US for corporate America start to rise, and that's probably a beneficiary, say, for our IT companies if that was the case. But in terms of tariffs, it depends. I mean, the biggest challenge will be, those tariffs for China and what China does. Will it, depreciate its currency more? Could it devalue its currency? What would be Europe's policy? If you're getting a stronger dollar, you've got a weaker currency. We could have a weaker currency too. Now, what that would mean is that you could actually have a global slowdown. So therefore, even though we're not a big exporter anyway, those are going to be under pressure, particularly those to Europe and elsewhere. So it's a bit it's not easy just to say our exports will pick up China +1. I can see that from an investment viewpoint that companies would want to diversify more towards India going forward, but that doesn't necessarily mean that your exports can rise. So I think it's a moot point. I think we're relatively better off than some other emerging markets and maybe Europe, but that doesn't mean we suffer if there's a global slowdown.
Right. So that's with regards to overall from a US market perspective. One quick event that I want to point out over here is the IPL, where the auctions have the first day of the auctions have concluded. Overall, Manish, I know you don't want to talk stock specific in this show, but from an IPL perspective, various sectors that we see that gain traction, from hotels, from the hospitality space to the consumption space to the aviation space. So from the listed entities or listed companies, where would your bets be?
So I am totally averse to buying consumer discretionary names. I think there could be some correction even from here, whether you talk about hotels, restaurants, QSR. You're not seeing any earnings growth, and because of the stress on the household leverage, we just saw, the MFI sector blew up in the second quarter numbers. And mind you, when household stress is visible, it doesn't really go away in a quarter or two. So wait for things to settle down, and we'll really look at earnings start to pick up on consumer discretionary. I think I am most comfortable in buying into an IT or a pharma or some of the platform companies, particularly when it comes to the financialization of themes, because here you have oligopolies, duopolies, where profit pools are going to be concentrated. You had a very strong Q2 earnings, and
Right.
capital market facing entities. These are the areas where I
Right.
believe.
So these are areas. Andrew, we're completely running out of time, but your quick pick from a sectoral perspective, and if you give a stock, will be great from an IPL standpoint that we're going to start soon. We just have 10 seconds.
Yeah, I can't talk on stocks, but I mentioned hospitality and beverages, so those are the two I would kind of bet heavily on this.
Absolutely, hospitality, beverages, that becomes a key to watch from IPL perspective as well. But thank you, gentlemen, so much for joining us on the show. It was a pleasure speaking to you and getting insights with regards to what retail investors should be doing in this day and age with the way the markets have been panning out, with what's happening across globally as well, that could be impacting us, whether it's time to hold, sit on cash or sell. That's all that we have on this edition of Hot Money. Lots more lined up on the other side. Please stay tuned to NDTV Profit.